Jerome be nimble, Jerome be quick. Jerome, watch out for that candlestick. Ah! Oh, Jerome, dude, what happened? Will the markets rally for the last full trading week in January, or will they fall like Jerome did tripping over that candlestick? We got a lot of big news coming up this week in the markets. Stick around, I'll tell you what I see coming up and what impact I think it's going to have on the markets. I'm Dr. Stock, Doctor of Education. Let's get right into it. We kick off the trading week on Monday at 10 a.m. with the Conference Board Leading Economic Index and Component Contributions. This leading indicator can tell us whether or not there is a recession being predicted in the future, and it's something that's highly predicted right now, recession that is, and highly talked about. And if you take a look at this chart that they have provided for us, we see the dot-com bubble burst that led to a recession back in the early 2000s, the housing market crisis back in the early 2008s, and when you look at this chart, you can see where the recession was signaled, that it was signaled before the recession hit, making it a leading indicator. And also you can see that for the 2008 housing crisis, before the market hit, we had that signal warning. And now as we fast forward to the pandemic, there really wasn't a whole lot of big warning there. There was a warning signal thrown, and then by the time the pandemic hit and the economy shut down, you can see that big old drop, and it recovered quickly, lasting only about 2 months. Now, as we get into the most recent period, we have a warning signal and a recession signal both thrown to us. So we'll see if that leads to recession like so many people are predicting. Our next big day for economic reports, in my opinion, is Thursday, January 26th at 8:30 a.m. when we get the durable goods order month over month for December and the GDP growth rate quarter over quarter advanced report for Q4 of 2022. Right now, the consensus is coming in at 2.6%, and we'll see the previous before that was 3.2%. So if that comes in cold, that could be a sign of a slowing economy for us, which could be a further indication of recession. Now, mind you, a slowing growth is different than a decline in GDP. We would need a negative reading in order to see that decline versus a slowing rate of growth. So I believe that a slow is expected from the 3.2 down to the 2.6, and we'll see if we get something well below that that could point to a quicker slowing pace of GDP growth, or is it something that will stagnate for us? I think Q4 is something that is going to come across sort of mixed for us. I think it's going to be below consensus, not by a whole lot. I think we'll be above 2%, but I think we'll be below that 2.6%, and we'll see as those revisions come in for GDP for Q4 as time plays out, and we find that out. Again, that GDP report comes out at 8:30 on Thursday, January the 26th, and that could be a very volatile day, or we could actually have a volatile trading week leading up to that time as we wait to hear the durable goods orders month over month report that I mentioned is also going to weigh into that. We'll see if we get another sharp decline following the decline that we had last month for November of 2022, and like I said, that report's for December 2022 coming up. Also at 8:30 on Thursday, we get initial jobless claims. We also get wholesale inventories. That is also happening at 8:30. We also get quarter over quarter advance notice for real consumer spending to track how it's believed that consumers are spending their money. Are they saving money because they think that money is going to be tight, or are they still very strong in consumerism that they're spending their money as it comes in? So we'll see how the consumers are holding out. We also get PCE prices quarter over quarter for Q4 at 8:30 a.m. on Thursday. Also at 10 a.m. on Thursday, January 26th, we get a report for month over month on new home sales for December. So we'll see if that comes in weaker than expected, stronger than expected, or about what's expected. Along with that comes the raw new home sales reading that right now the expectation is 0.614 million, so 614,000 new home sales reported for December. If that comes in soft and we see more drop in the housing market, that could also be a sign of further recession, which could be good news for us in terms of the Fed rate hiking, which right now is almost a near certainty for that 25 basis point hike on February 1st following the FOMC meeting that takes place on January the 31st through February 1st. Then finally on Friday, we get core PCE price index month over month at 8:30 a.m. Also personal income for month over month and personal spending month over month, all at 8:30 a.m. PCE being part of that report for personal income and outlays. So core PCE expected to come in at 0.3% and personal income 0.2%, and then personal spending month over month at negative 0.1%. So we'll see how we come in near those consensus values. Now, as far as the PCE goes, when we compare it to the consumer price index, as you can see on these charts that I have, the consumer price index, which is in blue on this chart, is the one that you see that continuously has the higher peaks throughout the chart. And as I scrub across, it's not very helpful for viewership, so I'll move along from there. Red seems to be a little less volatile, and that is the personal consumption expenditures as we look at those month-over-month values, which tend to be not as high or not as low, not as volatile as we have in CPI readings. So the negative 0.1% reading that we got for CPI could be something that gives us closer to even for, and this is for PCE for all items. This is not core PCE, we'll get to that next. But for this one, PCE, which is expected to come around 0.1%, I think even to 0.1% would be good for that one. And then if we move over from there to core, you can see even more volatility from the CPI still in blue, and that's all items excluding food and energy versus PCE excluding food and energy, which is in red. And that is far less volatile as we look across these two comparatively speaking, and there's a lot of correlation between the two of them and the movements that they make. And we see higher highs coming out of the CPI and lower lows coming out of the CPI, and we can see the PCE fitting right in the middle. So the core PCE coming in for this one, core CPI, for some reason it's not showing December on here. So when we compare CPI and PCE, I believe that it is reasonable that CPI coming in at 0.3% month over month for core CPI, and PCE or core PCE, which excludes food and energy as well, comes in at 0.3 to 0.2% month over month for December. Those are my expectations against the consensus of 0.3%. Then at 10 a.m. on Friday, January 27th, we have month over month pending home sales. So we'll see if that continues to decline, signaling possibly a stronger signal for recession, or even possibly leading to a deeper recession if we have a further slowing in those pending home sales for December. We will have to wait and see for 10 a.m. on Friday. Also at 10 a.m. we get the consumer sentiment Also at 10 a.m. on Friday, we get the University of Michigan Consumer Sentiment, the final report for January, which here you can see on the screen. You can see its movement over time and going extra low during times of recession, or leading to times of recession, and then building steadily following those recessionary periods that we have. This is one of the lowest times of recession. Let's zoom into something a little bit more recent here. There we go. So you can see the climb from 2014 all the way through 2018 and 2019, and then it's been falling ever since February of 2020. It's largely predicted that we're going to enter into a recession. The question is how deep of a recession and for how long. That part has yet to be seen, and what we have are clues coming in about that. So the leading indicators coming out at Monday, 10 a.m. So we want to watch the markets around those time, watch for that report to come out. Durable goods is going to be important for us too, to see if that is something that is falling off over time. We also have a GDP, the quarter over quarter for Q4 being reported to us. We'll see if that's something that we're still growing as an economy, which is expected to come in at nearly 3%. So we'll see if that's closer to the middle twos or down to 2%. So here's the thing. We have the chart of the SPY here in front of us, and we can draw on that trend line that a lot of people have been drawing across the tops of this thing. So let me grab a ray, we'll grab a top, there we go. It's drawn on for us. So that part is well known for us. And if we also take a look at the indicators and put on moving averages, we're looking at the 50-day and the 200-day simple moving average. The 200-day is in orange, that's this one, and then the 50-day simple moving average is in blue, and we had a death cross back here followed by a long fall. These are lagging indicators, And then over here that we could also be seeing a golden cross. And I think that this week's news is going to decide the fate of the markets. If we fail to break resistance again and we tumble back down, and that will be important to see. Do we hit another higher low, or are we going to hit the same low or a lower low? Are we going to break through any sort of support that we have as we look at this chart? So we'll have to watch and see how that plays out. Certainly whatever the Fed has to tell us January 31st, February 1st, so after the meeting on February the 1st, whatever they tell us, I think is also going to be very impactful. So I expect a lot of volatility coming up. If we get good reports, we're going to see a lot of green, and possibly we finally break through that resistance and get a better signal that we have some sort of relief from this bearish cycle that we're on. And if we fail to break resistance, I think that we fall probably pretty hard from here, because it means that the reports that we got were not strong reports. So especially if inflation seems to be a little bit more persistent than hoped, and also that the economy has slowed more than hoped, that would be probably worst case scenario, the double whammy of high inflation and slowing down of the economy. So things are getting more expensive and the economy is slowing down. We don't want that combination. We want to see that the economy might be slowing down a little bit, or sort of holding steady, or growing slowly. Those would be reasonable from where we're at right now. As a matter of fact, based off what's expected, we want to see still some steady growth, but not too strong, because that would make the Fed more hawkish. So coming in at expectation, I think we're okay. Coming in just below expectation, we still might be all right. However, if we really fall steeply below expectation, that could be bad for the markets as well, and it would not necessarily change the Fed's mind from being from the 25 basis point hike in the near term. However, the next rate hike, or it might impact the terminal rate from the Fed, that this would be their last 25 basis point rate hike. And that's if we get those strongly negative reports. That would be that the economy is slowing down way too much, way too fast, which could put an end to the quantitative tightening cycle, where the Fed would finally stop hiking rates, do a pause for a while, and possibly meaning a sooner pivot. So we'll have to watch that. If we do enter a steep recession and the economy is something that has contracted too much for too long, then it could turn into a Fed U-turn, where they start dropping rates. We move into another quantitative easing cycle and possibly start stimulating again. Now, mind you, that's something we have to watch out for, because if inflation's still in question, then stimulus isn't something that would happen too easily or too much, at least not responsibly. So that's what I have for you guys today. I hope that you enjoyed it. Enjoy the markets this week. I'll be back to talk to you more about some of the reports coming out. I have a lot of research done on PCE, and more talk about the personal income and outlays coming up. So I'll share that with you guys in the next day or two as I return to YouTube. Thanks for watching this video. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.